This is Eric Mother with Mother.com with the weekend market analysis for March 16th and March 17th, 2019. As we come close here to the end of the session, end of the week, which was an options expiration week. There's the bell. As the market is now closed, let's take a look at those charts. For the week, the S&P 500 was up 2.8%. And for the week, the NASDAQ was up the most, up about 3.8% for the week. And the Dow for the week was up about 1.56%. Let's take a look at the S&P 500 daily, where we can see a lot of good things happen this past week. We can see here we go below the 200-day moving average. In other words, we bounce below it, back above it with nice action. That's good. We also see support at the RSI 50 level, which is what bulls want to see. We can also see that this is an area of where there was a previous breakout of the RSI. Corresponding with this price movement here. And so essentially what we've done is we've come back to test the same area. If we take the line or the level here, this is uniform action below the line, back above it for the lows right there. Now also, we can see that if you go back to the previous breakout in price, based on this daily closing high, as we had discussed before, this was at 2737.70, going back to this daily closing high. And what happened here is we broke out, stayed above it. We came back last week and went below it, but did not close below it. In other words, that was a successful retest of the breakout, and now we are higher. So again, that's also another great development for market bulls. The fact that the previous breakout continues to hold and the market has not closed below 2737.30 since its breakout. So that's good. That's a level to watch. As long as the market is trading above this level, then this remains a bullish development. Now the other level to watch also is this recent daily closing high right here. And the level to watch there is at 28 or 3.69. Again, we can see that as of Friday's close, we are now on a new breakout mode. So simply put, as long as the market is above 28 or 3.69, that's bullish. And those who are looking for signs of a market that could weaken or drop or pull back from current levels, any failure to hold above this price would be net negative. Now there's another level. Go back to this daily closing high of October 2018, which is at 2809.92, which is this daily close right there. And what you see is that if we take that level and draw a breakout line, something like that, you can see the market had failed previously when trying to recapture this level here, came close here and failed. We tried to break out here on numerous occasions and failed. But the point I'm trying to drive home is right now we are above that price. So again, as long as we are trading above both levels, 28 or 3.69 or this level here, anything above this means that the market has cleared recent resistance. That's very bullish. And of course, if we go on to fail to hold these levels, then that would be a bearish sign. As we know, failed breakouts can be notorious for taking markets lower. A good example can be seen here on this chart, where we had a breakout attempt that failed, and of course that failed breakout attempt would lead to this shallow pullback here. So again, anything above this price levels is bullish, either this level or this level, and of course failure to hold above this price level can be seen as a net negative in the short term. So right now, the way we close Friday, good things happening there for bulls. If we take a look at a reason why the market could start stalling around current levels, is a couple of things here. Is we can see we had been going higher all week in prices, but you'll notice that the RSI generally has remained around the same level. So this is negative divergence. So as long as that remains the case, the 2 hourly is suggesting that as long as we continue seeing this negative divergence, then there is the likelihood that we are setting up for a pullback. Keep in mind where the RSI is stalling as of right now is around the RSI level of 61.8, which makes this negative divergence very relative and something we can consider watching. As long as the RSI fails and we see prices starting to drift lower, confirming this resistance, that's a sign of a market that is due for a pullback. And if the market is to move higher, then clearly we would need to take out the 61.8 level, and prices would need to break above the recent hourly level. So a breakout is needed in terms of moving above this line here of RSI resistance. Another way we can look at this also is by considering where we broke off the highs of mid-September. Coming off the highs, we break below here of the highs there, we can see that. But if we take that line and draw our uniformity resistance line, we can see that this is where the market's been struggling hour to hour, going back many weeks and months. Resistance here of those highs, a double top here, give us these highs, and we can see recently another double top recently here for this shallow area of resistance, and as of Friday's close, this is also showing resistance. We can also draw a line connecting the lows of the RSI, connecting this low and the lows right there, something like that. And again, we can see what this gives us is a backtest failure area with the hourly pullback towards the close of Friday's session, confirming resistance on these two lines. As long as these two lines are offering resistance, we can already see that the stage is being set for a market to be on a pullback mode early on in the week. Otherwise, if the market is to move higher, we would need to see the market moving and clearing the two lines of resistance and moving above this price range. Net, we can see here on the S&P 500, the dailies showing that the market is above a range. As long as that's true, then we can assume that this market continues to be acting well, and any failure to hold above the price levels discussed here would be a sign of a market that is due for a pullback. Now that concludes the free portion of this video. Enjoy your weekend. For subscribers, let's continue on.